Welcome to The Grow, Episode 2. This week we'll be discussing the business strategy of diversifying your regulatory risk for success. My name is Scott Sinclair. I am your host of this podcast, The Grow, which is about business fundamentals applied to the business of cannabis. This podcast is about moving past the negativity and the prejudices of this industry that we all know so well, and exploring instead the hypothesis that there is money available to be made, profits to be made, cash and capital available to be invested into your cannabis business. This podcast is not about the commodity, it's not about genetics, it's not about the efficacy or societal benefits. It is not directly about regulation, although we will discuss regulation from time to time. It's not about the hot new product. These topics are topics that are well covered by other podcasts. Instead, this podcast is about leadership. It is about management, and specifically about controlling the things that you can control. Treating the cannabis business like a real business, not like a passion, not like a new trend, not like a pastime, but real business fundamentals, controlling the things that you can control. The podcast is about money. Making more money, improving cash flow, restructuring fundamentals for those companies that need to do that, raising capital, creating shareholder value, and realizing, monetizing that shareholder value. And that is our focus here on The Grow. This episode is brought to you by Sinclair Range. Go to sinclairrange.com. Link in the notes. Sinclair Range helps all businesses, including the cannabis businesses, raise capital, turn around operations, restructure debts, generally execute on all of the strategies and possible transactions that come out of The Grow. Go check it out. Check out at the link and feel free to reach out with anything specific to your situation. You can only control what you can control. You can't control state and federal regulation decisions or lack thereof. You can't control Health Canada, Canada Revenue Agency, and their decision to come after you on your excise tax or not come after you on your excise taxes, but you can diversify your risk of adverse regulation from a business point of view. And I'm certain that's what you need to be doing. How do you diversify that risk from a regulation perspective? Well, broadly speaking, you need to be operating in multiple jurisdictions with different regulatory regimes, and you need to allocate your capital and your resources to those jurisdictions based on local fundamentals and success that you may be having in that market from time to time. Now, how can you operate in other jurisdictions if you are currently a uni-jurisdictional operator? Well, you can do that by expanding into other jurisdictions through organic growth. Go to that jurisdiction, the next one that you want to operate in, and open up an operation, make some investment, hire some people, start a business in that different jurisdiction. Or you could look to M&A markets, mergers and acquisitions, buy somebody, merge somebody, sell your business to somebody with a similar business in another jurisdiction. So now you have a couple of jurisdictions in terms of regulatory regimes covered off. You can strategic partner and you can do that in an internal operating or strategic partnerships with similar business in other jurisdictions. So you don't actually buy them, you don't sell to them, you're not merging, but you're not doing it yourself. You're working out some sort of loose or formal arrangement with another company in another jurisdiction where you think you might be successful. So you're sharing the burden amongst those couple of businesses. Look, some of you may run small businesses like our local retail stores here in town in the cannabis space, and I know some of them are listeners to this podcast. So you run a local business, and that's all you want to do, and that's great. That's absolutely great. But others want to build wealth. They want to build shareholder value, serious shareholder value and wealth, and they want to monetize that shareholder value, which means the business has to be sold to someone, public markets or a strategic purchaser, but that's how you monetize. That's how you realize and validate your shareholder value is some third party buys it. And to do that, you need to have EBITDA, earnings before interest, taxes, depreciation, amortization, and you need to have EBITDA at scale. And the EBITDA, it needs to be what we would call in the valuation business, maintainable. What's the maintainable EBITDA? In other words, it needs to be sticky. It needs to be there after the purchaser buys into your business, or they're not going to buy into your business, which means you need a mass of operations. Also, not to be subject, and you need to not be subject to the whims of a single individual local regulations, okay? You can't just be subject to one thing. The more you diversify, the more sticky your EBITDA becomes because you have more options. There is a wave of re-regulation coming to the industry in some areas. You know that. You've already started to see it. Your EBITDA can be, if you're just tied to one jurisdiction, your EBITDA, in fact, it probably, not only could it, but it probably will be regulated out of existence, which means your shareholder value is at risk. You need to diversify that risk. That is the right answer. And to do that, the larger industry participants have demonstrated success in globalizing their operations. They have the balance sheets, they have the expertise, and they are having some success at that. Remember, not so long ago, the industry at large was focused on its regional regulatory schemes and trying to earn a profit within those jurisdictions. So much capital was burned, not necessarily because the businesses were bad, although there was plenty of that, but because the regulatory scheme was simply unworkable. People used to talk about the global cannabis market. You'd see it in press releases, investor pitches, investor conferences, global cannabis market. But the truth of the matter is, there was no global cannabis market. There was a mishmash, a number of regional markets, each with their individual regulations that didn't work together very, very well. And so it was hard for any business to have a diversified approach. Well, that's going away. It's not completely gone away, but it has started to go away. And as the industry matures, more and more markets are becoming more and more functional. And it pays now to operate in multiple markets, not just for growth. Growth is great. Yeah, I want to expand to sell medical in Australia. That's great for growth, but it also, more importantly, diversifies regulatory and other risks, and to allocate resources. Once you've diversified that risk, to allocate your resources, your human and capital resources, to the markets that are working at any given time. If you've got two markets, market A, market B, and one is earning a profit and one it sucks, well, you should be allocating your resources to the one that's earning a profit. If you have 10 different markets, 10 different regulatory regimes, you can start balancing that out, and it's going to change over time. You can't do that if you're working in one single individual local market. So there's an article from the Business of Cannabis that's centered around Somai, S-O-M-A-I. I hope I'm pronouncing that properly. Somai Pharmaceuticals, a leading European biotech company specialized in medicinal? That's not a word. Medicinal cannabis manufacturing and distribution. The article says multi-state operators, or MSOs, have long represented the biggest and most influential cannabis players in North America. Yet as the market matures and expansion opportunities dwindle, new trends are emerging. The rise of multi-country operators, MCOs. As global cannabis reform continues to gain traction, businesses are now looking beyond state borders towards emerging markets across Europe. Dominant international operators like Curaleaf, Tilray, Aurora have been leveraging their weight to break into the UK and the European markets for some time, but new players are beginning to emerge, aiming to challenge those behemoths head-on. One company that has been built from the ground up with global outlook at its foundations is Somai Pharmaceuticals, which now operates in 12 countries and plans to expand to 20 countries by the end of the year. From the ground up. Remember, I gave you three options. You do it from the ground up, you invest, you hire a couple people, you build and build and build in the jurisdiction as if you were starting a new business in your jurisdiction, or you can do an M&A deal, or you can do a strategic partnership deal. Those are kind of the options to go beyond the jurisdiction that you're in. Well, Somai is doing this organically, predominantly, but not only organically. By the way, I don't hold to this, but I think Somai is from Portugal. And so, of course, it's not heading from the US to Europe, which is a more difficult task, nor from Canada to Europe, which is a more difficult task. But it doesn't change the fundamentals of what we're talking about. Somai is one of Europe's largest and most developed MCOs, again, multi-country operator, with vertically integrated operations spanning manufacturing, cultivation, and distribution. It also boasts the largest EU GMP-certified cannabinoid-containing pharmaceutical extract portfolio in the industry and indoor cultivation partners around the world. So they have strategic partners around the world in these different countries. That is a way, at a low cost, to have a win-win and not make a huge investment and start diversifying your regulatory risk. Many cannabis operators, particularly those which received outside investments throughout the initial quote-unquote green rush of the late 2010s and the early 2020s, have historically prioritized growth over profitability, buying up businesses and facilities which they were later forced to offload at significant discount. So that is one of the themes and the focuses of the Grow podcast, is we ought to be focused on business fundamentals, which means profit over growth. This paragraph in this article was about growth over profit, and growth over profit it's fine, but it only works if you have access to capital. You need to fund that growth when you lack profit. Capital markets or internal cash flow are the ways to fund that, and the internal cash flow will not last very long if you continuously lose money. So where we are at the industry right now, unless you have a healthy balance sheet and access to capital that nobody else has, you need to focus on profit over growth. Conversely, having learned the lessons from the period early on, Somai has adopted a more measured approach, prioritizing branding, profitability, and sustained margin expansion. This is exactly why I love this article. This is why I love it. I love it. Branding, margins, profitability are exactly what we need in this industry to create shareholder value. Branding, margins, profitability. One of just 5 fully vertical multi-country brands, Somai is unique in its ability to generate consistent profitability, realizing profits after just 1 year of sales. Quote, it's a real 100 plus SKUs, a portfolio of extracts, gel caps, oral gums, and inhalation products. We don't have just have one. We have 8 versions of gummies, 16 versions of vaporizers, and many oils, and now we're launching gel caps. So we have a really robust portfolio of EU GMP stabilized products. Sassano, who is the CEO, explained. So not only is he diversifying risk in terms of regulatory, he's diversifying risk in terms of products. Because as you know in your industry, and you could do that through strategic partnerships, by the way, on the manufacturing side, so that you're not investing in tooling and other capital equipment to build different products, of which 3 or 4 might be hot from time to time, and next week a different 3 or 4 are hot. As you know, that's a big problem in this industry of cannabis. It also differentiates itself from its competitors by focusing specifically on many craft, indoor, non-irradiated cannabis flowers as opposed to large-scale greenhouse-grown cannabis. So we're offering, this is a quote again from the CEO, we're offering consistent indoor flower, bringing similar value to big players who are pumping out volume greenhouse flower. There's just too much flower in the market, not enough indoor. And what he means by that, of course, is craft grow. So my CEO and founder, Michael Sassano, told the business of cannabis that when targeting the largest markets, such as Australia and Germany, along with secondary markets like the UK, Poland, and Italy, it's prudent to establish your footprint and then boost sales staff in the region. So stick your toe in, get set up, and then hire some sales staff is their strategy. Smaller markets, however, require a more nuanced approach. Somai tackles these by guiding its in-house sales team to partner, strategic partnerships, with big pharma distributors. Somai is also one of only a few groups that can make large market authorization dossiers for the hardest medical markets. If you're not investing in distribution and staffing, Brokers dealing with flowers, oil, and API deals are really hurting the business. To have secure, tradable supply lines at volume, you need a real system, large Q&A, inventory management teams, plus robust computerized management systems. Treat it like a real business. And most importantly, Somai boasts a $4.5 million euro credit line to trade product and offer sellers and buyers better cash flow management. He says, we own our own lab. We issue our own COAs based on EU Pharmacopoeia standards. This is a real value for all our trading partners who can be faster in the market with a reliable trading partner with full service quality systems that are required in big pharma. So when you're entering in strategic partnerships, whether that be on the distribution side, the manufacturing side, the packaging side, whatever, you need to focus on what you add value. Why are you unique? Why would someone want to partner with you? And in this case, one of the things they focus on is they own their own lab and issue their own COAs, so speed. Speed works really well. Now, they are a private company. I do not have their financial information. They claim in this article and in other places I researched to be profitable from day one. I can't validate for you whether that is true or not, or how they're defining profitability. Is it some sort of weird EBITDA, or is it actually net income? Like it ought to be, but either way, it doesn't matter. The point of this is the strategy, which I think is dead on. I love the strategy, and there are lessons for all of us in the cannabis industry. Diversify. Diversify your regulatory risk, and I'll throw in there, diversify your product risk, as if you can afford to do that, and profit over growth, one of the themes of this show. By contrast, High Tide reported this week their first quarter 2025 financial results featuring record revenue of $142.5 million. So for the first quarter of 2025, I'm not sure what that time period is since we're only in March 2025. So I don't know what the month ended is, but the first quarter of 2025 says their press release. Revenue increased to $142.5 million for the 3 months ended January 31, 2025. There we go. I've answered my own question. Gross profit margin was 25% for the 3 months ended January 31, compared to 28% year over year. So they are 25% gross margin. Now, we hate gross margin on the Grow podcast. We much prefer contribution margin. But even their gross margin is down 3%, from 28 down to 25%. They say that during the first fiscal quarter, the company took its Cabana Club loyalty program global across its ancillary e-commerce platforms. And as part of that strategy, the company proactively lowered its gross margin in its e-commerce segment, which is believed will be offset by increased volumes. Profit over growth? No, growth over profit. They purposely lowered their margin for growth. The company generated a net loss of $2.7 million for the 3 months, and the year before they were break even. They did not lose money. Adjusted EBITDA was $7.1 million in 3 months for the same period, representing the 20th consecutive positive quarter. Positive quarter in EBITDA. They lost money. Net income is real. EBITDA is not real. It's a good measure. It is a metric to value your business. Nothing else. Sometimes a loan covenant, but nothing else. It is intended as a metric to value your business. That is not net income. And they had a 32% decline from prior year. Why? Because their gross margins went down. That's why. Quote from the CEO, I also want to address the lower EBITDA number head on. This was due to a purposeful shift in our strategy to win market share in our ancillary business lines, which will provide long-term benefits by expanding our Cabana Club globally and diversifying our customer base. International opportunities in the medical cannabis space are very exciting, as we talked about, and can contribute meaningfully to our bottom line, acting as a hedge against short to medium-term volatility in our e-commerce platforms. Again, this idea of a hedge, of diversifying risk. Most cannabis companies that come to me and to Sinclair Range are looking at international growth as a way to grow. They're not looking at it from a risk management perspective and a capital allocation perspective. I think that's what you ought to be doing. We look forward to leveraging our $1.5 billion procurement expertise with Canadian LPs to fulfill demand in the growing German medical cannabis market, as well as other international markets in due course. Okay, so that was the topic for today. multiple regulatory jurisdictions to diversify risk, diversifying risk, capital allocation to the least risky markets is a tremendous way, a terrific way to create shareholder value in the industry of cannabis. We also talked on profit over growth. This last release from High Tide is all about growth over profit. Now, I'm not saying you can't do that. I'm not saying you can't do that. But to succeed, you have to have the cash, which means you need to have access to capital. Back in the heydays, back in the green boom or whatever they called it, when you could raise money in a Canadian LP, and to lesser extent, but to some extent in the US, you could just raise money on a PowerPoint slide. You could do growth over profit. The capital was available. You either need to have access to capital right now, or you need to have the internal cash flow if you're going to prioritize growth over profit, or you will guaranteed hit a wall. The other thing you need to do is be able to forecast and manage your cash needs with that strategy, or you will hit a wall. All right, that's it for the week. Thank you for listening to the Grow podcast. Everywhere you go to listen to podcasts, I want you to subscribe, like, participate, reach out. Reach out if you're in the industry and you want to be a guest on the show. This is only episode 2, so it's been hard to book guests so far, but we'll get there. I've created podcasts before. We'll get guests on, but please reach out if you have topics you want me to cover. Let's do that. Reach out. Let me know in the notes. Suggest some topics. And with that, I will talk to you next week. Thank you for listening.